The final lesson of the 2026 banking collapse was not that money disappeared, but that it changed shape. While the masses were focused on the closing of bank branches, the architects were watching the silent death of the dollar's purchasing power. We have moved from a crisis of availability to a crisis of value. If you followed the liquidity protocol from our previous session, you already have your lifeboats in place. You have your tactical cash, your jurisdictional diversification, and your strategic reserves. But now, we must address the predator that never sleeps. The Great Devaluation. In an era where central banks are printing digital credits to cover the systemic holes left by the zombie towers and the failed regional lenders, saving is no longer an act of prudence, it is an act of self-destruction. In 2026, the traditional 60-40 portfolio is not just obsolete. It is a financial suicide note. The old world relied on a balance between stocks and bonds, assuming that when one fell, the other would rise. But in the aftermath, we are seeing the correlation of zero. Both paper assets are being eaten alive by a hidden inflation rate that far outpaces the official government numbers. The architect does not look at the consumer price index. The architect looks at the shadow inflation, the cost of energy, the cost of quality food, and the cost of real, unencumbered land. To survive this, you need a portfolio that isn't just diversified, but you need a structure that thrives on the very chaos that destroys the traditional investor. This is the anti-inflation portfolio, the second pillar of your financial sovereignty. The first rule of the anti-inflation portfolio is the rejection of nominal wealth. Most people are thrilled when they see their portfolio grow by 10% in a year, even if the cost of living has risen by 15%. They are celebrating their own decline. The architect measures wealth in units of utility. How many hectares of productive land does your capital represent? How many barrels of oil? How many ounces of gold? When the currency is being reset, the only numbers that matter are those that represent physical reality. We are entering the age of hard assets, a cycle that history tells us occurs every few generations, when the debt of an empire becomes unpayable. In 2026, we are at the terminal stage of that cycle. To build this portfolio, we must first understand the vulture phase of the Great Reset. As the commercial real estate market in cities like New York craters, we are seeing a massive transfer of wealth, but it isn't moving into the stock market. It is moving into direct ownership. The architect is moving away from ETFs and mutual funds, which essentially just digital promises managed by institutions like Blackstone, and moving toward counterparty-free assets. If you own an ETF that tracks gold, you own a piece of paper. If you own physical gold in a private vault outside your home jurisdiction, you own the asset. In 2026, the paper bridge between the investor and the asset is being cut. If you don't hold it, you don't own it. This brings us to the core of the strategy, the barbell approach. On one side, we have ultra-hard assets like physical precious metals and decentralized, finite, digital assets that cannot be printed into oblivion. These are your wealth insurance. They don't generate cash flow, but they ensure that your purchasing power survives the transition to the CBDC. On the other side of the barbell, we have productive real assets. This is where the true growth happens in the aftermath. We are talking about farmland, specialized infrastructure, and residential real estate in exodus cities, those locations where people are fleeing to after leaving the zombie zones of Manhattan. These assets provide something that a bank account never will: essential utility. No matter how much the dollar is devalued, people still need to eat, they still need energy, and they still need a roof over their heads. By owning the supply of these essentials, you become the one who sets the price, rather than the one who pays it. We must also discuss the debt arbitrage strategy. In a high inflation environment, not all debt is bad. While we warned against the debt trap of high-interest consumer credit, the architect uses fixed-rate, long-term debt as a weapon. If you own a productive asset financed at a fixed rate while the currency is losing 10% of its value every year, you are effectively being paid to borrow money. The real value of your debt is shrinking, while the real value of your asset is rising. This is the secret mechanism that the billionaire class is using to strip mine the middle class during the reset. They are shorting the dollar by longing real assets. To follow the anti-inflation portfolio, you must learn to stop being the one whose savings are being devalued and start being the one whose liabilities are being erased by inflation. However, this requires a level of discipline that most investors lack. You cannot day trade the anti-inflation portfolio. This is a generational build. The 2026 collapse proved that the get-rich-quick era of cheap leverage and crypto memes is over. We are back to the fundamentals of the 1970s, but with 21st century technology. You must be prepared for extreme volatility in the nominal price of your assets while remaining focused on their intrinsic value. When the headline says gold drops 5%, the architect doesn't see a loss. They see a discount on the only insurance policy that has never gone bankrupt in 5,000 years. This mindset shift is the most difficult part of the architect's journey. You are no longer playing the game of the markets. You are playing the game of history. To truly master the Great Devaluation of 2026, we must dive deeper into the concept of debt arbitrage. In the previous era, debt was seen as a burden, a weight that pulled you down. But in the aftermath of the banking collapse, the architect views fixed-rate debt on productive assets as a short position against the failing currency. Imagine owning a multifamily property in a high-demand Exodus city, financed with a 30-year fixed mortgage. As the central banks pump trillions into the system to prevent a total freeze, the purchasing power of each dollar is halved, while the nominal price of your property and the rent you collect climb to match the new reality. Your debt remains frozen in the past. You are paying back the bank with cheaper dollars money that buys less for them, but was easier for you to acquire through your rising rents. This is the only way the middle class can reclaim ground during a reset. If you are sitting on high-interest, variable debt, you are the victim. If you are sitting on low-interest, fixed debt tied to a real-world asset, you are the predator. However, the anti-inflation portfolio also requires a brutal assessment of essential commodities. We are moving out of the age of information and back into the age of atoms. In 2026, the global supply chains are no longer frictionless. Regionalism is replacing globalization. This means that the resources required to run a civilization, energy, minerals, and food are becoming the new global reserve currency. The architect allocates a significant portion of their portfolio to the energy stack. This isn't just about oil and gas, it's about the infrastructure that moves it, pipelines, uranium for the resurgence of nuclear power, and even private solar and battery storage installations on your own property. In a world where the power grid is as fragile as the banking grid, energy independence is the ultimate hedge against inflation. If the cost of a kilowatt-hour triples, the person who produces their own energy has seen their wealth triple relative to their neighbors. We must also discuss the role of intellectual liquidity as an anti-inflationary asset. In the 2026 economy, your ability to solve problems that the new system cannot solve is a form of capital that cannot be taxed, confiscated, or the architect invests in their own skill stack, specialized knowledge in engineering, regenerate agriculture, or high-level crisis management. When the paper markets are in a tailspin and the zombie towers are being liquidated, the person who can rebuild, secure, or sustain is the one who will always be able to trade for hard assets. This is the human capital component of the barbell strategy. While your Theater 3 assets provide the floor for your wealth, your skills provide the ceiling. You are not just preserving what you have, you are increasing your ability to acquire more as others are forced to sell. The final pillar of this portfolio is privacy-preserving assets. As we discussed in the Great Reset, the transition to CBDCs will make every traditional transaction transparent to the state. This level of transparency is the ultimate tool for targeted inflation, the ability to devalue specific sectors or individuals through programmable social credit. To counter this, the architect holds assets that exist outside the eye. This includes high-value collectibles with established global markets, physical precious metals held in private, non-bank vaults, and decentralized cryptographic assets that prioritize privacy. These are not for speculation, they are for transactability. If the system decides to freeze your digital wallet because you exceeded your carbon limit or participated in the wrong part of the economy, these privacy-preserving assets are the only way to maintain your agency. They are the smokescreen that allows your portfolio to move in silence. As we look toward 2027, the gap between the paper class and the asset class will become an unbridgeable chasm. Those who remained in the old 60/40ths model will find themselves owning a larger number of dollars that buy a smaller and smaller share of the world. Those who adopted the anti-inflation portfolio will find that their units of utility have not only remained stable but have granted them an unprecedented level of influence over the new landscape. The Great Devaluation is a fire that burns the dross and tempers the steel. By choosing to hold atoms over bits, utility over promises, and fixed debt over variable risk, you are tempering your future. The architect does not fear the fire. The architect uses the heat to forge something that the system can no longer control. This is the end of the second pillar. Your liquidity is secure, and your value is protected. Next, we must address the final gate, the debt destroyer.